Welcome back to the deliberations of CNBC-TV18 Citizens Monetary Policy. I've been speaking with Chairman of our committee, Dr. Sen, and members Samiran, Sajjid, Soumya, and Sonal. Gentlemen, and Sonal, thank you very much for your patience. Dr. Sen, actually growth has been very good. The NSO has upped this year's estimate to 7.3, and next year's growth is also 7%, according to the CEA and the Reserve Bank governor. So why does the economy need any rate cut by way of stimulus?
Growth is good for a particular segment. I mean, the corporate India has done extremely well in the last 2-3 years. The point is the non-corporate sector isn't in that great shape yet. And they are the most interest rate sensitive. So the thing is that if you want to maintain a growth rate of around 7% into the long term, we'd have to get the corporate and the non-corporate sector back into some kind of a balance. At the moment, it is seriously imbalanced. So the focus is going to have to shift. The second thing, Lata, is that if you look at the data that we have from the corporate sector, corporate performance has started to slip a little bit. So one cannot take that growth for granted as of now.
Yeah, of course, those headwinds could be there. But Sajjid, your estimate of growth, are you as confident as what everyone is saying? 7.3, 7%? Is growth safe?
Well, I think one has to be cognizant that in 2024, even though the world will be, in some kind of soft landing, that doesn't mean that we won't have headwinds. The global economy is slowing. We can see that both in, goods exports and service exports. So that will be headwinds. In 2023, India benefited from this large terms of trade shock as commodity prices came down. If to the extent that commodities stabilize or even move up a little bit, those tailwinds go away. And fiscal policy has been supportive last year. The broader consolidated deficit was flat last year, and there will be meaningful and necessary consolidation next year. So there will be headwinds from growth. I think from an inflation perspective, Lata, very quickly, I think the reason the RBI can take some comfort on core inflation going forward is if you look at the drivers of core, really, it's goods inflation that picked up last year because input costs around the world went up and firms had to pass it on. The minute commodity prices stabilized, goods inflation has come down. In India's case, services inflation just hasn't responded. Right? We've seen low services inflation for the last few years, and that would suggest to the central bank that there is still some slack in the economy. Labor markets are not too tight. On a broad-based wages are not picking up and pushing up service costs. So India's inflation story is very different from what we are seeing in advanced economies in terms of tight labor markets, high wages, high services inflation, and therefore gives the RBI later this year, when they've got more confidence about inflation trajectory, a little bit more elbow room.
Oh, okay. So you're arguing that inflation is not that big a threat. But Samiran, what could happen, going by the way the numbers are, that core comes down? It's already at 3.8, it may go even below 3. And around 2, it is actually deflationary. It has a bad impact on the economy. But food may not oblige. It may continue to be high, and so the headline of 4 may be elusive. What does the Reserve Bank do at that time?
See, Lata, this is a very clear problem for any central bank, that it can't influence food prices. It can only influence core in that sense. And while we also have a tendency of putting all the blame on vegetable prices, but if you look at the non-veggie food inflation, that over the last 4 years have averaged more than 6%. And that's something which is creating this continuous pressure on the headline inflation. But having said that, why this is important to track the headline is that if you look at the cumulative headline inflation over the last 4 years, that's already almost 30%. Now, that kind of tells you that why in the lower segment of the population, there is this pressure on consumption, because the income growth might not have matched with that 30% overall inflation. So in other words, we could keep the headline inflation lower for longer to ensure that the purchasing power comes back with the lower segment and you have a more sustainable consumption growth.
Oh, so that means they have to persist with that pressure on interest rates. Soumya, the one thing that the external members will be upset about is that the repo rate has not been at 6.5. So do you think that will be a pressure now, and the Reserve Bank will have to move in the current policy in some fashion, maybe with liquidity, to bring it down towards 6.5?
No, I think, Lata, as of now, as I said at the beginning, that liquidity is going to be a little bit of worry for the central bank next year also, because next year you have those bond inflows peaking. So that's why I'm saying that why not build up a counter-cyclical buffer into the system, which can adjust it when the monetary policy cannot be adjusted. But having said that, I think just to harp on those inflation trends, I think even the fact that the core inflation has trended down to below 4%, but I think there is a limit to which core can increase, and we are of the view that the decline in core possibly could have bottomed out. So in that sense, I think even though there is an element of headline and core converging in the Indian context, but my sense is that that is not likely to happen at this rate. So at somewhere maybe around 5% or so, they could convert. So from that point of view, I think there will be still pressure on the central bank not to adjust the rates of the liquidity as of now.
Okay.
If they have got the things under control, why not wait for one or two policies to see how durable is the decline, and then take a call on rate adjustment in the future.
Okay, so that's the feeling I'm getting both from you and Samiran. But Sonal, if you can wrap it all up, would you say that we are moving closer to a rate cut at all since inflation has started obliging? What's your summary, say, advice or expectation from the MPC?
Yeah, Lata, I think one step at a time. Growth has surprised positively. I don't think, we're talking about rate cut imminently. At the same time, the withdrawal of accommodation stance, which is a signal that the next move is a hike, is not necessary because we have seen actually core disinflation play out, and some of the risks have not materialized. I think given that backdrop, we need to follow, I would say, like a sequence two-step procedure. First is tackling liquidity. Yes, it is frictional, but it's been tight now for since September. So it's a fairly prolonged period of stealth tightening, and it's come in the backdrop of macroprudential tightening that the RBI has done, which will have some moderating impact on consumer credit going forward. So I do think liquidity is extremely important to tackle at this stage, and the tools that the RBI decides, I think, for instance, more longer term VRR, FX swap are options that are on the table and should be utilized to ensure that the call rate gets back within the corridor rather than staying above MSF or at MSF. That's a step I think should be addressed in this particular policy meeting. Step two is basically the policy guidance. We don't need to be signaling a hike. We don't need to be signaling a cut right now. But the stance has to essentially remove that tightening bias and move to neutral. So these are two things I think are quite important at this current juncture.
Okay, this looks like a divided house. So now as we get to the vote, I think it's going to be very interesting. First, the action, and there perhaps there'll be more agreement. Let me start with the first question. What will be the rate action from the MPC on Thursday? Samiran?
We are not expecting any policy rate action.
No action. Pause. Sonal?
Pause.
Okay. Soumya?
No action.
Okay. Sajjid?
Pause.
Okay. Dr. Sen, what do you vote?
Hold.
Hold. Okay. Pause. So the chairman is with the committee. That's unanimous. But I think on the stance we may have, let me rephrase the stance. Should the stance remain the same, prepare the markets for a change, or actually change? So, Sonal?
Prepare for change.
Prepare for change. Samiran?
Our base case is for no change in stance, but we would not be surprised if RBI does change the wording a little bit.
Okay. Okay. Soumya?
No change in stance as of now.
No change. Okay. Sajjid?
I would think, given inflation, soften the language to prepare for some change.
Prepare for change. Oh, good. We are getting some disagreement here. Dr. Sen?
They should prepare for a change, but at the moment, I think given that nothing else is happening, I think it's better that they move to neutral so that the investors are given the feeling that better days are ahead.
Okay, so that's 3 different votes. 2 people no change, 2 people prepare for a change, and the chairman go ahead and change your stance. A final quick question. When do you all expect the first rate cut? Sonal?
August, with risk of earlier cuts.
Samiran?
We are also in August.
August. Okay. Soumya?
Second quarter, mostly August.
Okay. Sajjid?
If the Fed cuts in May, June is on the table, I think.
Okay, June and 3 August. Dr. Sen?
Not before June.
Okay, well, that's more or less. It's either June or August, and the committee is divided. I think it's for August that they are voting. Thank you very much, members of the committee. It is a little divided in terms of stance, but I think the big takeaway for me from the committee is liquidity is the bigger problem. And there we have 2 unusual suggestions. Samiran saying an incremental CRR cut, and Soumya saying a permanent counter-cyclical buffer to adjust liquidity. Thank you very much for this MPC deliberations.